Hello, everybody. It is time to get started with our 1031 Exchange webinar. I hope everybody is doing great. My name is Leonard Spoto, and I'm going to be your host today. I do have a special guest, Jason McMurtry, as well, who's going to talk a little bit about DSTs. So he will be joining us as well. We're going to hang tight for about 60 seconds. We have a bunch of people kind of in the waiting room looking to log in. So give us about 60 seconds before we formally start today's presentation. All righty, I think we're good, guys. Are you ready? Let's go ahead and get started. So, as I mentioned, my name is Leonard Spoto. I run a company called Asset Exchange Company. We are a 1031 exchange accommodator. And each and every month, we do a series of 1031 exchange webinars. Today's webinar is 1031 exchange basics. So what we're going to do today is just kind of talk at the basic level about what a 1031 exchange is, how to follow the rules, and answer any questions that you guys might have about the process. So before we do get started, though, let's do a little bit of housekeeping regarding questions. The way that you answer questions, or excuse me, ask questions on today's webinar is to type your question into the questions dialog box. So each of you on your webinar control panel should have a little questions dialog box. Go ahead, and if you have a question, open that box up, type your question in, and when you do that, it will pop up on my computer screen. Now, I do try to answer all questions as they are appropriate. And what that means is your question might be a fantastic question, but it might be something that we're going to talk about later in the presentation. So if so, I will address that question later in the presentation. And then I'm going to be honest with you, sometimes there's just questions that aren't really going to be on topic. So I will generally not answer those. Or if they're really, really personal and it's something that I don't feel is a good discussion topic for the entire group, I will send an email after answering that specific question. And then sometimes we just don't have enough time. And if we can't get to your question that is sent over during the webinar, don't worry, I will follow up via an email and answer the question. And if it's really burning and you haven't heard from me, right away, you can feel free to just call my office or email me as well. But all of your questions are appreciated and welcome. They do make the presentation a lot more interesting for your hosts here. So please do ask questions. We encourage it. Secondly, everybody generally, a lot of people actually ask for a copy of our presentation material. And what we do is we have an automatic email that goes out about an hour or so after the presentation ends that includes a link to all of our presentation material. If you don't see that email in about an hour or so after the presentation, just check your spam folder. If you still don't see it, shoot me an email and ask me specifically for a copy of the material. Sometimes for whatever reason, we have a hard time getting emails through some spam filters because they think we're spam. And then finally, we do these presentations and we do a lot of education because we want to earn your business. So if you think we do a good job today, I guarantee you that is the exact same impression we will give you and your clients when we work together as your 1031 exchange accommodator for your transaction. So if you do have a 1031 exchange coming up, give us an opportunity to make you look good with your clients. I guarantee you and more importantly, your client will be very satisfied with the 1031 exchange process when it's handled by our company. So join us today for free education, but do give us an opportunity to earn your business if and when you do have a 1031 exchange coming up. All right. with that said, let's jump into the presentation. So my company is a 1031 exchange accommodator. And when you do a 1031 exchange, you can defer taxes on the sale of your investment property, but you have to use a 1031 exchange accommodator. All right. The tax law requires it. And a lot of people who haven't done exchanges before, they're not familiar with what a 1031 exchange company or a 1031 exchange accommodator does. So let's go over what the role or the function of the accommodator is. Number one, if you're gonna do an exchange, you need to set up an exchange account with the 1031 exchange company, and you need to do it prior to the close of escrow. Because when you do a 1031 exchange, you cannot touch your money. If you are in what's called constructive receipt of your sale proceeds, you are going to pay taxes. So at the close of escrow, if you plan on doing a 1031 exchange to defer your taxes, all of the funds from the sale of your property will get sent to the 1031 exchange accommodator, and those funds will sit in trust until you're ready to buy your replacement property to complete your exchange. So very, very importantly, number one is we as an exchange company are going to hold all of the sale proceeds until our clients get into contract on a replacement property. And then we'll wire out those funds so that they can close on the new purchase property to complete their exchange. So think of us kind of like your 401k custodian, right? You have to work with your 401k custodian who holds your money and manages your investments so that you can defer taxes, right? We're very similar to that, but we're specific to the 1031 exchange process. So first and most important thing we do is we hold the sale proceeds. Secondly, we are going to prepare all of the legal documents that are required to properly document your 1031 exchange according to all the IRS rules and regulations, all right? So we're going to prepare all the legal documents. The client is going to sign all of our legal documents for both the sale and the purchase properties. And then finally, we're going to make sure that you or your client is in compliance with all the rules and regulations set forth in the 1031 exchange guidelines. So there is a ton of stuff that can foul up a 1031 exchange. And we're going to make sure that your exchange doesn't get fouled up, because if any of those little things get tripped up, you could owe hundreds of thousands of dollars in taxes. I'll give you an example. We had a client who was all set to go and do a 1031 exchange. They're going to go sell their property. They had a buyer lined up, and they called me and said, well, geez, the property we're going to buy to complete our 1031 exchange is owned by our mother. Okay, that's a problem. Okay, you can't buy a property in a 1031 exchange from a direct related party. So that doesn't work. And the client, obviously, they're not going to know those kind of things, right? Because it's a very kind of minute part of the tax law. First of all, the 1031 exchange is a very minute part of the tax law. And then the related party issue is a much more kind of niche area, even within 1031 exchange. So it is not our client's job to go out and become an expert in the compliance issues for 1031 exchange. That's our job. We're going to make sure that the clients are in compliance so that they don't have a big giant tax bill to pay when they think they're going to go out and defer all of those taxes. All right, so we take our job seriously. We're very good at it. We've been doing it for over 20 years. We have a tax attorney on staff. Our tax attorney has trained our entire team, but we think, and we'd love you to think by working with us, that we are the best in the business. We're really, really good at what we do. And as I mentioned earlier, we'd love a shot to earn your business to prove that. Now, as I mentioned, we've been doing this for, I've been in the business for 20 years. We started this company back in 2006. We handle hundreds and hundreds of exchanges every month. As a company, we are bonded and insured, which is required by state law. I mentioned we do have a tax attorney on staff. He is a member of the California Board of Accountancy, as well as the State Bar of California. One of the unique things about my company, we do offer audit support. Now, you might think, well, geez, I don't need audit support. And you're right, you don't unless you get audited. And about 5% of our clients get audited every year. And when you get audited, you have two options. You either go out and hire a $750 an hour tax attorney who probably doesn't know the 1031 exchange tax law as good as us or have nearly as much experience, or you come to us and we help you defend the position that you took in your 1031 exchange. So we cannot represent you in tax court, but we can help you avoid going to tax court because we know the rules and regulations by far, in most cases, better than even the auditors, because we do this stuff every single day. And as I mentioned, we do a couple hundred exchanges every single month. So this is our lifeblood here, just the 1031 exchange process. Okay, so let's talk 1031. Now, when you do a 1031 exchange, as I mentioned earlier, you're doing your 1031 exchange so that you can defer taxes on the sale of your investment property. And Section 1031 has been called one of the single greatest wealth building tools available to the investor. Now, why is that? Well, it's because if you do not do a 1031 exchange and you sell your investment property, you cash out and you pay taxes, 1/3 of your gain or your profit is going to go to the government. All right. Tax rates are generally about 33 to 35%. Now, it varies somewhat depending on what state you're in, but it is safe to assume that if you do not do a 1031 exchange, 1/3 of your profit is going to go to the government. So on every deal, every real estate deal that I own, I like to joke that I have 3 partners: me, my wife, and Uncle Sam. And everybody is going to get paid if we cash out. Now, my goal with my investments, and hopefully this is yours as well, is to never pay Uncle Sam his share, right? The government doesn't need to take hundreds of thousands of dollars of my hard-earned money. So what we're going to do is we're going to employ Section 1031 of the Internal Revenue Code when we sell our investment properties to defer that tax bill, meaning we do not have to pay that tax bill to Uncle Sam if we conduct a 1031 exchange. We get to defer that tax liability. So we don't have to pay Uncle Sam today if we do an exchange. Now, notice that I said the word today, right? We're not going to pay Uncle Sam today, but because this is a tax deferral, if and when we eventually cash out of our property, guess who's going to get paid? All of my partners. So I'm going to get paid, my wife is going to get paid, and Uncle Sam is going to get paid if and when we stop exchanging. All right, so let me give you a little example of how this could work and show you kind of the power of the 1031 exchange process and why it's called the greatest wealth building tool available to investors. All right, I'm going to start off with $1 million property. Okay, I'm going to sell that property and I'm going to go exchange into a $2 million property. Okay, I don't have to pay taxes, right? Because when I sold this $1 million property, I went out and exchanged into another one. And I used all of my money to go out and leverage into this new bigger property. I didn't have to pay the government their share. Now this $2 million property that I bought, it's now worth $5 million, all right? So it has appreciated to $5 million bucks. And guess what? I've got a ton of gain, but I'm not gonna pay taxes because I'm gonna do another 1031 exchange and I'm gonna buy a $6 million property. All right, so I've done a couple exchanges here. I've done an exchange from my original property to the new one. I sold that new one for a huge profit and I went out and I bought another big apartment building. And maybe I've done this over 5 years. Maybe it's been 25 years. In either case, guess what? I have never paid taxes on my real estate sales. So what I've done is I've been able to build wealth through real estate without paying taxes and leverage into bigger and better income producing properties throughout maybe 5 or, as I mentioned, 25 years and never pay Uncle Sam. Now, the problem is this is a tax deferral. So if I decide to cash out of this $6 million property, guess what? I'm going to pay taxes, right? And I'm going to pay taxes on the profits from this apartment building and all of my other transactions that got me there. So if I cash out of this $6 million apartment building, I might have to pay Uncle Sam a huge tax bill. Maybe it's $2 million. Maybe it's $1.5 million. Maybe it's $250,000. Whatever my gain is on those deals that I've exchanged into over the years, Uncle Sam's going to get his share of it. Now, ladies and gentlemen, that is only if I cash out though. So guess what? I'm not going to cash out. I've got this apartment building here that I bought for $6 million. Maybe it's worth $12 million now, right? So I've got this $12 million apartment building and I'm 75 years old and I have owned it for 25, 30 years. I acquired it in a series of exchanges and I'm just not going to sell it. And what is eventually going to happen is I am going to pass away. And when I pass away, we are going to have employed one of the most powerful strategies in the 1031 exchange world, which I refer to as the 3 Ds of investing. So pay attention. The 3 Ds of investing are defer, defer, and die. So we have deferred into a series of properties that got us our ultimate beautiful $12 million apartment building that produces a ton of cash flow that I can actually live off of. And I've owned this property until I've died. Now, when I die, do I have to pay my capital gains taxes? No. When I pass away, what's going to happen is my heir, which is going to be my wife, because I guarantee you she's going to live longer than me, she's going to get a stepped up basis. And when she receives that stepped up basis, essentially all of the capital gains tax liability that we have been deferring over our lifetime of investing, that tax liability, those gains go away. That's right, you heard me correct. Those gains go away. My wife can sell that $12 million property the day after my funeral and take all of the cash for herself and pay absolutely nothing to Uncle Sam. Now, let's not get my wife too excited about this because I want to stick around. I don't want to have any poison in my tea, right? But this is a fantastic strategy. It's called the defer, defer, die, or the 3 Ds of investing, right? You want to own those properties until you pass away. And then when you pass away, let your wife or your kids or your cat, whoever's going to inherit your property, benefit from that step up in basis. So, ladies and gentlemen, the single greatest wealth building tool available to the investor, Section 1031 of the Internal Revenue Code. If you are a real estate agent, if you are a real estate investor, this is a strategy. This is something that you need to understand because it's going to have very important implications for your financial well-being. So, how does it work? Well, if you are planning to do 1031 exchanges, you need to know your options, all right? And there's a handful of different ways that you can do a 1031 exchange. Now, a lot of my clients will call me and they'll think that they have to swap properties, meaning you sell a property and you immediately swap into something else the same day. Now, there's good reason for some people to think that this is the way you do an exchange because when it was originally designed, there wasn't a lot of criteria on how to do a 1031 exchange in the tax law. So people thought that they had to sell and buy and do what's called just a simultaneous exchange or a simultaneous swap. You sell today, you buy something that same day, and you complete your exchange. Well, yes, you can do that but it's not required. Okay, so simultaneous exchange is kind of hard to line up your sale and your purchase and have them close concurrently on the same day. It's an option for you, but I do want to let you know that it's not the only option. All right. Prior to 1972, the government gave us a little bit more flexibility on how to do the 1031 exchange. Excuse me, post 1972. They gave us the option to do what are called delayed exchanges. And the delayed exchange is exactly what it sounds like. You have a delay between your sale and your buy or your purchase. Now, I'm sure most of you or many of you know what that delayed time frame is. You probably have remembered it or you've seen it from your real estate training courses. You have 180 days to complete the purchase of your new property. So when you sell, you have a delay. You have up to 180 days to go out and buy your replacement property. So you don't have to do it simultaneously. And this is great news because it gives you, the investor, a lot more flexibility. It's going to make your life a lot easier with obviously some due diligence. So delayed exchanges are about 95% of my business. Now, we, as I mentioned, do a lot of exchanges every month. By and large, most of our clients are doing these delayed exchanges because it's really the easiest, the most simple way to conduct a 1031 exchange. So if you're doing an exchange, chances are you will do it with a delayed exchange where you sell and then you have up to 180 days to buy. Now, it's, again, not the only way to exchange. There are some other ways. You've got the simultaneous, and you also have what we call, what I like to refer to as the more complex or complicated ways to exchange. You have a reverse, and you also have construction exchanges. Now, I'm not going to spend too much time on these type of exchanges because, number one, this is a 1031 exchange basics class, and number two, not a lot of people do these type of exchanges because they're just really difficult. But I will discuss them briefly, all right? So a reverse exchange allows you to do your 1031 exchange in reverse, all right? So instead of selling your property first, you're gonna buy it first. And then you have up to 180 days to get your property sold. And as long as you get that property sold within 180 days, it's gonna be a tax deferred sale. Now, I know many of you are thinking, well, geez, that sounds way better. I'd much prefer to buy my property first, secure it, and then go out and sell my property. Well, it's not that easy. The problem with the reverse exchange is you can't just go out and buy real estate today and later, within the next 6 months, sell something and call it an exchange. Unfortunately, with a reverse exchange, I have to become the buyer of the new property on your behalf because you, as a exchanger, cannot own the new property and the old property at the same time, right? You can't be on title to both properties and call it an exchange. I have to become the buyer of the new property. Once you sell your property, then I can transfer the new one to you. That's how reverse exchanges are done, and that causes a lot of complications for financing. There's also a lot more fees involved, and there's also duplicate transfer taxes. So yes, we can do reverse exchanges, but just know that they're going to be more expensive and a bit more complicated, and they're really difficult to finance. All right, so that's the reverse exchange, which is an option. And then finally, we have the last option here, which is the construction or the improvement exchange. And these are kind of neat in theory, but kind of difficult in reality. So what happens with the construction improvement exchange is you can sell your property and you can use the money from the sale to build or improve replacement property. Sounds great, right? You can't find something that you want to exchange into, so you think, well, geez, I'll just build it. Well, the problem with that is that you still have the 180-day time frame to comply with. So you'd have to buy the land, get your contractor lined up, all of your permits in place, and you have to get everything done within 180 days. Now, I don't know about you, but my contractor told me my remodel of my backyard was going to take 6 months, and it took well over a year. So doing a construction or improvement exchange is very difficult because of these time constraints. Now, we do have clients that do them, but generally it's people who really know the construction process very well, and they've got their permits already in place, and they just kind of know what's going on with the construction world. If you're like me and you got to go out and hire a contractor and wait in line for permits and all that stuff, it's going to be very challenging to get these construction improvements exchanges done on time. But I do want to let you guys know there's different options for you. Now, most of our clients, again, will do the simple option, but if you have clients that are interested in these other types of exchanges, what I suggest you do is you pick up the phone and you schedule a conference call with either myself or one of my teammates, because we want to make sure that your client really understands these other options before they go out and commit to something. All right. So one of the things that I would recommend you do right now is, if you haven't already, go ahead and put my phone number in your cell phone. All right. Okay. So we are, easy to get to. Put me down in your cell phone as, 1031 guy. And when you do have clients who ask about these more advanced type of exchanges, just don't hesitate to give us a call. All right. Because what I don't want your client to do is go make an offer to buy something thinking they can do a reverse exchange, close on it, and then after the close of escrow realize, uh-oh, I needed to get Leonard and his exchange company involved prior to the close, because that's just not going to work, right? Okay. I am wanted to remind you guys that if you have questions, go ahead and type them in. I'll try to address your questions when appropriate, and if I can't get you answers to the question during the presentation, I will email you an answer to your question. Okay, so let's talk about the guidelines for doing a successful 1031 exchange. There are 4 of them. Guideline number 1, when you do a 1031 exchange, most importantly, you got to make sure that your properties are eligible. Now, as I mentioned earlier, the 1031 exchange process is for investment properties. Now, it's a little bit different, or a little bit more, it's a little bit more exact than that. The government says that the properties have to have been used for productive use in trade or business or for investment. So really what that means is, if you've got a rental property, any type of investment property, or any type of business property, you can exchange it. All right. So you might think, well, I have an office building for my real estate company. Can I exchange that? Absolutely. Right. Because you run your business out of that property. A rental property, that's an investment. Right. So any type of business or investment property is going to be exchangeable. Now, the tax code also stipulates that properties involved in a 1031 exchange must be like kind. And that can be a source of confusion for a lot of my clients. Some of my clients will think, well, geez, if I sell a 2-unit building, do I have to go out and buy another 2-unit building so that it's like kind? The answer is no, you don't. Okay. The government says that all real estate is like kind as long as it's used for business or investment purposes. So you can sell land that you have a farm on, and you can 1031 exchange into a rental home. You can sell a rental home and buy an apartment building. You can sell an apartment building and buy an office building. You have a lot of flexibility. You can go anywhere in the country. So you could sell this land in California. You could buy in Texas, in Florida, in New York. It doesn't matter. All right. As long as you are buying an investment or business use property within the United States, you are good to go. Now, there are a couple exceptions, okay? Number 1, you cannot exchange outside of the United States. So if you want to sell in California and buy in Mexico or China, that will not work. And number 2, quick flips are not exchangeable. Okay, what is a quick flip? A quick flip is when I buy a property, I fix it up, and I sell it. Okay, the reason why quick flips are not exchangeable is because the government considers those to be inventory, and the government prohibits inventory from being exchanged. All right, so inventory is something that you buy with the specific intention to sell. All right, so if you go into a grocery store, you go to the fruit section, and the bananas in there are inventory, right? Safeway or Ralph's bought those bananas to sell them, and it's inventory. And inventory is not exchangeable. Real estate can be inventory. If you buy something with the specific intention to sell it, then it is inventory and it's not exchangeable. So a quick flip would be inventory. If you are a developer, your development project that you built and immediately upon completion listed for sale is inventory. So developers and flippers are not doing exchanges. If you want to do exchanges, you need to hold your property as investment or business use property. And typically what that means is that you run your business or you rent the property out for at least a year or two. You report the rental income on your tax filings, you depreciate the property, you have signed lease agreements with your tenants, and you do that for at least a year or two, and you establish that property as an investment or business use property, and then you are eligible. All right? So what I want to see you do is hold those properties long enough so that you can qualify. And if you have any questions about whether or not your property is going to qualify, I want you to pick up the phone and give me a call, because there's always all kinds of weird scenarios where your client was renting the property, but then the tenants left and then they put their son or daughter in the property and they were kind of paying rent, they kind of weren't. Well, real life is ugly and messy, okay? And if you have an ugly or messy situation and you're not quite sure your property is eligible for an exchange, pick up the phone and give me a call. Now, we have a question about what if the property is rented out, but it's generating a loss? Well, hey, that's just not a great rental. It will be a rental and you can exchange it, but if you're, operating a loss, it's just not a great rental, but it is still a rental. So don't worry about that. Obviously, if you're operating too big of a loss, you might want to sell it right away or sooner rather than later because of that, but it's not going to prohibit you from doing an exchange just because it's not generating as much cash flow as you were hoping. Okay, let's move on. So guideline number one, make sure that your properties are eligible and will qualify. Guideline number two, and this is really important, guideline number two is because a lot of people get confused on this. And the reason why they get confused is because they go on the internet or they talk to their uncle's brother's best friend or whoever it is that just did an exchange. And a lot of people will say, hey, when you do an exchange, all you have to do is reinvest your profit. That's not the case. All right. So pay attention. Guideline number two is very important. When you do a 1031 exchange, if you don't want to pay taxes, you have to reinvest your cash, all of it, and purchase property equal or greater in value. So let me give you an example. I'm going to sell my property for $1 million after commissions and closing costs. And that's very important. I hope you guys caught that. After commission and closing costs. So my net sale price after commission and closing costs is $1 million. Now, you might only have $200,000 of profit in this property. I don't care. In order to pay taxes, in order not to pay taxes on that profit, you have to go out and buy $1 million or more worth of real estate. And you need to spend all of your cash. So you sold for $1 million, you paid off a $700,000 loan, that gives you $300,000 of cash. That cash needs to be used as a down payment on this property and you're buying for $1 million or more, so you're going to have to go out and either get a loan or bring in additional cash of $700,000. That, ladies and gentlemen, is how to successfully do a 1031 exchange and not pay any taxes. Do not listen to your brother's, uncle's, best friend's cousin who says, no, 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 all you have to do is spend your profit. That is absolutely false. Some other people will come to me and say, well, geez, I heard I only had to spend my cash, so I want to buy something for $300,000. That does not work. Okay, you need to replace the value of what you sold. Now, what happens if you don't replace the value? Well, if you sold for $1 million and you trade down in value, so let's say I buy something for $900,000, it's not the end of the world, but you're not going to have a 100% tax deferred exchange. You're going to pay some taxes, okay, because you didn't follow all the rules. So if you sold for $1 million and you buy for $900,000, the difference of $100,000 is going to be taxed. And we call that boot, all right? So when you have some money left over, or you trade down in value, in our industry, we call it boot, and boot is taxable. So you might have heard that word before, boot. It just means that you don't have a 100% tax deferred exchange. You're gonna pay some taxes. You're doing a partial exchange, okay? So don't let the internet fool you. Whenever you do an exchange, if you don't want to pay taxes, you got to replace the whole value. Now, you can be creative in how you do this. If you sell a property for $1 million, you could buy a property for $1 million or more, or maybe you want to go out and you want to buy multiple properties. So that's fine. You sold for $1 million, you want to buy 2 properties for $500,000. That works as well. So you can do a multi-property exchange. You can sell 1, you could buy 2, 3, 4. You can also sell 2 or 3 and buy 1, all right? So you have some flexibility on how you conduct your exchange. You could do multi-property exchanges. You could do partial exchanges and choose to pay some taxes. But most of my clients, they say, hey, I don't want a dime going to the government. So what do I have to do? If your client asks you that, you tell them reinvest all of their cash and purchase property equal or greater in value. Make sense? Perfect. All right, let's move on. We discussed this briefly in the very beginning. Timeline for your exchange is guideline number 3. Whenever you do a 1031 exchange, you have 180 days to complete the process. Your timeline starts the day you close escrow, okay? Close of escrow is day 0. You have 180 days from that point to go out and purchase and close on your replacement property. Can you get an extension? Well, I used to joke that no, you couldn't. It was impossible because in the past it was impossible, but now the government has been giving extensions to taxpayers affected by natural disasters. So we have fires, we have hurricanes, we have all kinds of different national, federal disasters. And when there is a presidential disaster declaration, the government will extend these timeframes. Now, don't count on it, okay? So don't go into an exchange assuming you're gonna get an extension, because you probably won't. But in the rare case that you are affected by a presidential disaster declaration, you may get an extension on this. Now I say may because the government enacts kind of weird rules on who qualifies and the timing and whatnot. But it will be safe to assume that you're probably not going to get one. So know these timelines well, all right? Plan on completing your exchange within the 180-day period. Make sure you close on your replacement property on or before that date. And within this day, note that you have to identify what you're thinking about buying on day 45. So 2 very important things to keep in mind. 180 days total to complete your exchange, but within that time frame, you're going to have to identify what you're thinking about buying on day 45. Now, how do you do that? Well, identification is done pretty simply. You identify using an identification letter. Now, my company is going to provide you with that letter. So on day 45, you're going to fill out this letter and you're going to nominate your properties that you're thinking about exchanging into. You're going to sign and you're going to date this letter. And then when you identify the properties that you're going to exchange into, you can only buy properties from that list. So very, very important is knowing how to fill out this letter. There are two options to fill out this letter. Option number one is to use what we call the 3-property rule. And guess what? With the 3-property rule, ladies and gentlemen, you get to put 3 properties on your letter. Now, the problem with identification is that once you submit your letter on day 45, you are now locked into buying something from that list. Hopefully, the first property on the list is the one you really want and you can get it. But if not, if someone else buys that property, you're going to have to go to your second option. If you can't close on the second property, you're going to go to the third. Now, if you cannot acquire the third property, you are out of luck. All right, you get 3 bites at the apple. If you cannot get any of them, and you're past your day 45 identification period, you are out of luck. You've got a failed exchange at that point. So very, very, very important. Make sure that you are identifying properties that you've got a good chance of closing on. Because after day 45, there's no going back. So you get 3 bites at the apple. Hopefully you get your first choice. If not, you got a second backup and then a third option. The 3-property rule gives you 3 bites at the apple. Now you might be thinking, well, geez, Leonard, I'm going to sell a big expensive property in California for $5 million. I want to go to Texas and I want to buy 6 or 10 or 15 properties. Can I do that? Absolutely. But you need to use a different method of identifying on day 45. So the 3-property rule, you only get 3 properties. So if you want to buy more than 3 properties, you're going to have to identify using the 200% rule. The 200% rule says, hey, you can nominate as many pieces of real estate as you'd like. All right, so in this example, I've got 6 properties, and that's fine. There's no limit on the number of properties. However, there is a limit on the value. So the value of all the properties that I've identified, all 6 of them in my example, cannot exceed 200% of what I sold. So if I sold this property for $5 million, I have a limit on what I can identify, and that limit cannot exceed $10 million worth of real estate. Now, that could be 6 properties, it could be 10 properties, it could be 20 properties. But the value of all these properties cannot exceed 200% of what you sold. Now, who came up with this rule? And why is it 200%? Why is it only 3 properties for the 3 property? I don't know, right? But it is what it is. The government gives us a tax deferral. They build these rules out through time. And then as long as we comply with these rules, we get to defer our big tax liability. So yeah, it's kind of a pain. 3 properties is a little bit confining. 200% might be kind of confining. But if you're willing to work within the confines of the law, you get the huge benefit of not having to pay that tax bill to Uncle Sam. So we jump through these hoops, but we do it for a very good reason, because our ultimate plan may be to what we talked about earlier, defer, and then die. And we might invest over 25 years and never have paid the government. Okay, so these rules are very important. So let's recap. Number 1, we want to make sure that our properties are eligible. Number 2, we want to reinvest all of our cash and replace the value of what we sold. Number 3, we got to get our deal done within 180 days. And number 4, we have to identify what we're thinking about buying on day 45. Now, ladies and gentlemen, there are a lot of different options that you can 1031 exchange into. And one of the biggest questions I get is, can you exchange into a REIT? And people ask me that all the time because they don't want to own real estate anymore. They want to have a passive investment. They're tired of dealing with the tenants and the toilets and the trash. And the bad news is no, you cannot exchange into a REIT. And the reason why is a REIT is not real estate. A REIT is a company that owns real estate. And when you buy into a REIT, you are buying shares of that company. And for the 1031 exchange process to work, you have to buy real estate. Now, the good news is that the big giant real estate companies that own REITs came up with a solution. And that solution is called a Delaware statutory trust. It functions like a REIT, where it is a passive real estate investment, but it gives you fractional ownership of a very large institutional property. So take a look at the screen. You could buy a little slice of this property. Maybe you own 1% of it, and it is completely managed by the real estate company that offered the product. And you, as an investor, are just along for the ride. Now, a lot of our clients ask about these type of investments. And because of that, we have a special guest speaker today. His name is Jason McMurtry. He actually sells DSTs. And what I'd like to do is I would like to pass the screen over to Jason. So I'll introduce him, and I'm going to give Jason the opportunity to share his screen. So Jason, you can share your screen now. And I know that some of you have asked questions here. Once Jason is done with his portion, I'm going to go ahead and go through and answer some of these questions that I did not get a chance to answer. But Jason, go ahead and take it away.
Thanks very much, Leonard. I appreciate that. Thanks for being on the call to everybody today. So as Leonard laid out, the 1031 exchange strategy can be an extremely effective tool to build wealth. But as you walk through sort of some of the rules and timelines, you were probably thinking, that some of those may be obstacles, that there may be some reasons that people might be hesitant to do a 1031 exchange if, for example, they're worried about having to replace the entire value of the property that they sold because of a large loan, or they're worried about the timelines, or they're worried that they might only find a property that costs less than the value of the property that they sold. And the reason Leonard asked me to be on today is because the Delaware Statutory Trust can solve a lot of those problems and make the 1031 exchange go much smoother, even if you never need the Delaware Statutory Trust, even if you never need the DST. But as a real estate professional, simply knowing how the DST works and making your clients aware of it can give them significant confidence that they need to move forward with the exchange and use the DST only if needed. So what I'm going to do over the next 15 minutes here is just go over the basics of a DST so that we can explain which problems DSTs solve. And then I want to talk about how this is really an opportunity for you as a real estate professional. So let me kick off by giving a high-level overview of DSTs. These are regulated by the Securities and Exchange Commission. So even though they're comprised of real estate, they're considered investment securities, and they're regulated at the federal level by the Securities and Exchange Commission rather than departments of real estate. And the Securities and Exchange Commission has one big important rule about investing in these, and that is that investors must be accredited. An accredited investor is simply somebody that has a net worth of at least $1 million, excluding their primary residence. So their stocks, bonds, mutual funds, savings accounts, all their real estate investments. If you add all that up, subtract out any debts against it, if that's at least $1 million in total, then they are accredited and they can invest into DSTs potentially. If they don't have $1 million net worth, but they do have a $200,000 income, or if married and investing together a $300,000 income, they're also accredited and can invest in DSTs. So let me do a quick introduction before I get into the details of DSTs, just let you know a little bit about who I am and who 1031 Capital Solutions is. I founded this company. We're going on our 8th year here. And when you add up our managing partners and senior advisors, we have more than 50 years of combined experience exclusively in the real estate space. We've helped our clients invest in over $300 million in DST transactions in our company's history. And we have a large inventory of DST properties. So as one of the leading providers of DSTs in the country, we have access to all the DSTs that are nationally syndicated. We put them through a very rigorous due diligence process to determine which properties and which investments are most suitable, and we recommend those to our clients when it's appropriate. We use what's called a best interest standard or a best interest duty, which means that all of our recommendations, our advice, our guidance to our clients must be in their best interest and not driven by commissions or structure or anything else. It has to be what's in the client's best interest. We use a financial planning process. So we developed proprietary software to do analysis on existing properties and help with the analysis that is done through a 1031 exchange, including cash flow analysis, tax analysis, comparing various investment scenarios, and more. We're really strong on education. So at the end of this, I'm going to show you where you can find a bunch of free resources on DSTs and 1031 exchanges. And we work with our clients throughout the transaction, and then we're their advisor for that account for the life of the investment. I wrote a book called How to Retire from Being a Landlord. It covers everything I'm going to talk about over the next few minutes and a lot more. If you'd like a free copy of the book, I'd be more than happy to mail a copy to you. At the end, I'll give you the contact information and show you how you can request that. So what are DSTs? Real high level, these are fractional interest investments into commercial real estate. The IRS took a look at this structure 21 years ago. I can't believe it, it's been so long. And issued a revenue ruling basically blessing DSTs as like-kind property for real estate. So this is not a gray area. We're not pushing any envelopes. The IRS has granted permission for people to invest in DSTs for replacement property. The number one reason that people invest in these is because they want a passive real estate ownership experience. So DSTs are not suitable for somebody that's early in their investment career and trying to build a real estate portfolio. These are fantastic for people that have had a wonderful real estate career and they want to exit their real estate, but they don't want to pay the taxes. So they have to do a 1031 exchange into something. And rather than exchanging into another property that they would have to manage and deal with, they can invest into a fractional interest of a large commercial property and have a purely, totally passive investment experience. All of the DSTs are very high quality, very large institutional properties with institutional asset management and property management. So you're not going to see a duplex or a fourplex or even like a 10-unit apartment building as a DST. If it's a multifamily property, it's going to be a 200, 300, 400 unit apartment building, could be a 100,000 square foot industrial building leased to Amazon or FedEx. It could be hotels, offices, retail, student housing, senior living. It could be any type of commercial property, but it's going to be very large and institutional in nature, and it's going to be managed by a large national institutional real estate investment company. We at 1031 Capital Solutions have a very wide variety of options. So we want to have different types of properties in all different sectors because each person that comes to us has a different desire from a financial standpoint. They're comfortable with different sectors of real estate. So we want to have all different varieties for people to choose from. Some DSTs are a single property, many are a single property. So you might have a 400 unit apartment complex in Denver, Colorado, as an example. And when you evaluate that, you would evaluate it the same way you would any other property. There's an appraisal, there's an inspection, there's a rent roll. So all of those materials are provided and investors can evaluate those when they're considering which properties they want to invest in. Some DSTs are structured with multiple properties. So you might invest in a single DST, but it has 2 or 4, sometimes even 10 or 12 properties in that DST. So an investor might get the benefit of diversification with a single investment. So they're getting one direct deposit for their rent every month. They're getting one quarterly report. They're getting one tax statement at the end of the year, but their investment is actually spread across maybe 10 or 15 investments. One of the really great benefits of DSTs is the flexible investment amount. So Leonard mentioned earlier that if you sell a property for $1 million net and you buy your replacement property for $900,000, well, you're going to pay tax on that $100,000 gap between what you sold and what you purchased on the buy side. Well, you could take that $100,000 and invest that into a DST. Well, what if it were $104,912 that was left over? The good news is you can invest that exact amount into a DST, and that will purchase you a certain percentage of the DST property. So whatever odd lot is left over, or whatever odd lot you have because of your exchange, you can invest down to the last dollar in a DST, and all of that money goes to work for you. So it makes it really easy to find replacement property because you're not trying to match it to the last dollar there. DSTs have 2 primary exit strategies. The conventional DST is one where you invest today. The DST company is going to manage that property on behalf of all of the investors. They're going to make regular distributions of net rent to investors. They're going to provide all the reporting. And then at some point in their future, usually within 5 to 10 years, they're going to sell that property and return the funds to investors. And when that happens, the investor, if they want to continue the tax deferral, they're going to have to set up a new account with their exchange accommodator, probably Asset Exchange, and then they're going to find another replacement property and do another exchange. When they do that, they can exchange into another DST property if they want, or if they prefer to work with their real estate professional and go back into a property that they find on their own and own 100% of the property, they can do that too. Their funds are 1031 exchangeable. There's another exit strategy that's growing in popularity, particularly for older investors, that does not require subsequent 1031 exchanges. And that strategy is called the 721 UPREIT. So in this strategy, the investor would invest in a DST, just like any other, but they go into a DST knowing that in about 2 to 3 years, that DST property is going to be acquired by an affiliate REIT, a real estate investment trust. And when that happens, the investor's investment in the DST will convert automatically into operating partnership units of the REIT. And that is a tax deferred transaction. And the reason somebody might do this is if, let's say they're 75 years old and they're doing a 1031 exchange today, they may not like the idea of having to come back to the table 5, 6, 7, 8 years from now when they're in their 80s and do another 1031 exchange. So by doing the 721 UPREIT, they do the exchange today, it automatically converts to the REIT, and they're never going to have to do an exchange ever again. They can access their funds in the REIT by selling shares after a couple year illiquidity period. So let's say 5 years later, one of the spouses passes away, or they don't pass away, they just want to get to some of their money to spend it or give it away or whatever, they can sell shares of the REIT at a time of their choosing. Both of these are good strategies. It really just depends on the individual circumstance. Age is a huge factor here, and we can consult on both of these strategies. Regardless of which strategy you pursue, the process of investing in a DST is typically very simple, very easy, and very quick relative to a typical real estate transaction. If a client were to call me today and say, you know, I'm under the gun, my 45 days is tomorrow, I really need to pick an investment, we can go from reviewing multiple options to narrowing it down to filling out paperwork and being closed in that property in a number of days rather than weeks or months. So it's very quick and easy. An interesting characteristic of DSTs is when you invest in them, all the fees and expenses that are associated with going out and finding the property, doing the due diligence, arranging the financing, negotiating the purchase, hiring the investment bank, broker dealers, financial advisors, they're all wrapped into the price of the DST. So if you have for example, $1 million investment, all the fees and expenses have already been baked into that $1 million price. And if it has, for example, a 5% net cash flow, we would multiply 5% times the full $1 million for a $50,000 a year cash flow in that example. One of the things that we do automatically for our clients when it's appropriate is some financial planning around the exchange. So sometimes somebody comes to us and says, I own a property, I really don't know if I want to sell it or not. We can do an analysis on that property to figure out the financials. So we'll figure out the net cash flow, the return on equity. People often have a really good idea of how much rent they're collecting, but when you get into not just the current, but the future expenses of that property, people often are not very clear on what they have. What I mean by that is our analysis will take into account, obviously, expenses related to the mortgage and taxes and insurance and maintenance and repairs, but we also factor in future vacancy and turnover cost and capital expenses that are going to happen into the future to determine what the real current cash flow is when we budget for those items. We can then compare that to the market, and they can see if they were to do an exchange, whether their cash flow would go up, down, or stay the same. We can estimate taxes for the client and game out different investment scenarios. They might say, well, my financial advisor says if I sell the property and pay the taxes and invest with them, they can get me X% return. Well, we can model that out and see how that compares to doing a 1031 exchange so the client can figure out what's in their best interest. We will take this information to make recommendations and then go back and forth with the client until we find a portfolio that works for them. This is a service that we provide free of charge to most of our clients just as part of our planning process. As I mentioned at the outset, we're really heavy on education. And so if you go to our website, which is 1031capitalsolutions.com, there you will find a library of free resources. You do not have to give us your contact information, your email, your phone number, anything like that to access these materials. So there's DST investor checklist, there's brochures, there's short videos, long videos, recorded webinars, and the like. This is something that you can go to educate yourself. You can send your clients here to educate themselves so that they can understand the benefits of a DST. So to kind of tie a bow on this, Leonard mentioned that there are time frames, 45-day time frame and 180-day time frame. If a client is reluctant to move forward with a 1031 exchange because they're worried that they won't be able to find something in those time frames, introducing a DST to the conversation may solve that problem, because you can tell them there's 20 DSTs out there. If we get to day 44 or 45 and we can't find property, you don't have to pay tax, Mr. Client. You can instead go to a DST to save your exchange, and then when you come out of that exchange in the future, do another one into the property you want. So it'll give them the confidence to move forward with an exchange. If they can't get financing, they have a loan on their property, they want to sell it and exchange into something else, but because of their financial situation or their age or any other reason, they cannot get financing, they can go into a DST, and it solves that problem, because the property is financed already and the client gets pro rata share of the financing. So it automatically replaces their debt. If they're worried about buying a property that costs less, or maybe they're planning on buying a property that costs less, you bring a DST to the table and show them you don't have to pay tax on the difference. We can invest that remainder into a DST. But here's the major message I want to deliver today. The most important element of DSTs for real estate agents is that it solves one of the biggest problems facing the biggest demographic in our country, the baby boomers. One of the biggest problems these folks have is that they spent their life accumulating real estate to generate retirement income for themselves. And then when they got to retirement, they realized they can't stop working. They have to continue to work on these rental properties in order to get that income. And maybe they got a property manager to simplify things, or maybe they got some triple nets to try to simplify things. But what they realize is They have to continue to deal with the tenants, with the property managers, with refinancing loans, with maintenance issues. And when they get into their 60s and their 70s and their 80s, they don't want to do it anymore. The problem is, if they don't know about a DST, they think their choices are manage this until I die. So wait till I'm 90 years old and just, this is my retirement now, I guess, or sell it and pay a huge capital gains tax. And that capital gains tax generally keeps people from doing anything. So they're not selling the property, so their problem's not getting solved. You as the agent don't benefit, and we don't have a client. But if that investor learns about DSTs and they learn that they can sell the property, defer the taxes through a 1031 exchange, and get passive income from a DST, a lot of those people are now motivated to sell their rental property. They have solved their problem. You got a listing out of the deal, and we got a new client. So the more people know about DSTs, particularly in that 60 and 70 and 80 age group, the better we're all going to do. They get their problem solved, you get a listing, and we get a new client. So,
hey, Jason, we're just about out of time. So yeah,
Yep.
I was going to ask you to share your information there. So if you guys have further questions about the DST process, please take note of Jason's contact information there. It's going to be on the screen for about 10 more seconds here, and then I'm going to switch over. I've known Jason for almost 20 years now, and he has worked with many of our clients and is a great resource for these type of products. So take his phone number down. If you have further questions, he can send you his book, etc. I'm going to go ahead and share my screen as well. Please do, oops, that's not how I share my screen. Please do keep both Jason and I in mind. It would be our pleasure to work with you. I know that a lot of you people join the webinar today just for some basic information, but a lot of you also have clients who are considering an exchange in the next month or so. So use us as a resource. We're available if you want to make introductions to the client. We consult at no charge. We do these webinars at no charge, but we are really trying to earn your business. So keep that in mind. If you have a client doing an exchange and you thought we did a good job today, again, that's the exact same impression we're going to give your client. So we're good at what we do. We like doing it, and we love to work with you. I know that some of your questions were answered and some of them weren't. If I wasn't able to answer your question during today's webinar, I apologize. Please do email me if you don't get an email from me with your specific question answered. And as I mentioned at the beginning of the presentation, we will be sending out a link to the copy of this 1031 exchange presentation that I went over. Jason will also send out his material as well. So we're going to go ahead and wrap up. Thank you. I apologize for going over the limit. We were supposed to end within an hour. We're shortly over that, so I apologize for that. But thank you all for your time today. We appreciate you and look forward to working with all of you, hopefully at some point in the future. Take care, everybody, and have a great day.